All right, joining us now to talk more about earnings season and the market, Sylvia Jablonski, Defiance ETFs CEO and CIO. Sylvia, good morning. So the pattern continues, at least so far, with these names we've gotten, beating the most recent earnings estimates, although mixed reaction in aggregate by the market here. Where do you think that places us after really kind of a ripping rally in the indexes as we try to absorb all the corporate results?
Good morning, Mike. Well, it has been very much a rip-roaring rally in the first half of the year. And statistically, that is actually on pace to continue. If you look at the first 10 first halves that have been up as much as we are now, 100% of the time, the index ends up rallying into the end of the year by an average amount of 23% and a median of 27%. So the rally can actually continue. This is kind of a shaky rally, though, because I think a lot of investors missed out on it, came back into it, caught the tail end of it, and kind of came back out in fears of this recession and, the Fed rising rates about 11 times and keeping us in this kind of, restrictive mode. But corporate earnings are proving otherwise. The economy remains strong. You have a company like Caterpillar out there reporting today stellar earnings, and that's an economically sensitive name. That tells me that the economy is still on good, steady ground. The consumer is continuing to spend. Earnings are coming in stronger, as you believe. So I do think we have a shot to continue into the end of the year with a rally.
It's fascinating. In the last couple of weeks, I would argue, as a lot of the bearish or skeptical arguments have been essentially cast aside by the continuing rally. People were worried after we got the debt ceiling deal that, oh no, the Treasury is going to have to issue so much debt, yields are going to surge. All that stuff is largely followed by the wayside. But one of the issues now is, inflation's on the downswing, but is that going to be a problem for corporate revenue growth and margins down the road? So I wonder if that's going to be the next challenge or one of them for the markets here.
I think that'll be the next kind of, fear mongering that'll come into the market for sure. There's definitely a sense of pricing power that comes in inflation, and people sort of at the whole believe inflation is bad, but pricing power wise, it does sort of help corporate America. But what I think is going to replace that, that pricing power, first of all, I don't think prices are necessarily going to come down. They perhaps just can't go up as quickly. But what replaces that, I think, is all of the money that's sitting on the sidelines. You still have savings of trillions and these 5%, money market rates that people are invested in. I think once that starts to fall to the side and people come back to the market, that liquidity picture is what keeps us going forward.
Yeah, although I would say, even though we're at record like money market fund assets, it's not that huge compared to the market cap of equities the way we saw, like, let's say 15 years ago. Though I did want to get to a little bit of the flavor of the rally recently in terms of some of the more aggressive parts of the markets really running. I know your ETFs, maybe some of them would be in this category of, kind of aggressive growth or the meme stock ETF, some crypto related. A lot of heavily shorted stocks have been rallying very hard. Is that something that you feel as if it's just risk appetites returning to normal, or should we be a little concerned about the froth?
Yeah, so I think, the way that we look at it actually is that we look at innovation and tech and growth in disruptive sectors. So, for example, Tesla's rallying, Rivian's ripping, and an electric vehicle type of ETF might rally right now because of the, massive global growth there that we've seen from some of these makers. AI and machine learning, we know, has been all the rage, but it's also something that's going to actually contribute to top and bottom lines for companies as we, kind of globalize and make supply chains more efficient and use machine learning for whether it's Merck or Pfizer. You talked about Keytruda and those drugs, getting efficiency there. So I think you have to pick your stocks, right? Crypto meme stocks, I don't know. I think that's sort of risk appetite and investor excitement without maybe fundamentals. But if you look at growth and innovation in sectors that are likely here to stay for the next decade, like electric vehicles, like AI, like machine learning, I think that is sort of healthy risk appetite coming back into the market and seeing the future of growth potential for the tech generals and some of the names leading the market now.
So what then would be on your list of things that we now should legitimately potentially be concerned about? We do have, yields have inched higher. Oil is on the climb again as well. It maybe is going to put upward pressure on inflation. So it brings the whole Fed equation and where they're going to have to settle out with short-term rates back into the discussion.
Yeah. So what worries me, and I think what could be, potential headwinds for the market would be I think that, the Fed is always the wild card here, right? And I think if we get more rate hikes than we anticipate, then I think that that does sort of stall growth for the economy. I also think that geopolitical issues are sort of always out there. And, we saw that with Russia and Ukraine quite some time ago, but tensions with China and kind of where that lands on trade agreements and things like this will certainly impact big tech, semiconductor companies, and future innovation and trade revenues for the U.S. So I think those are two factors that we'll be looking at.
And then I know you were talking about kind of the innovation centric parts of the market, but where do overall valuations place us in terms of what we can expect from returns from here? As I was mentioning earlier, the S&P is up 30% off the lows and pushing 20 times forward earnings.
Yeah. While all of the major indices have rallied, what's been good about this rally, and I think you've mentioned it before, and you've been really mentioning it daily, is that you're starting to see breadth and participation in the market. So I think that as long as earnings continue to come through, and we're seeing kind of that slow and steady growth across various sectors, outside of tech and semiconductors, and then you can sort of also see what can continue to pump the gas for those names. And again, that is tech and innovation. AI, machine learning, cloud, cybersecurity, the way that we're transforming our lives with technology. I do think that there's room to run on the valuations, although they're high. And, valuations have been high for quite some time now in the tech generals, and they continue to perform. If you look at their earnings season, they're coming in with ad spend, they're coming in with bottom line revenues from some of these investments in AI and increase in corporate spending and things like this.